Pure Financial Advisors, a registered investment advisor. This show does not intend to provide personalized investment advice through this broadcast and does not represent that the securities or services discussed are suitable for any investor. Investors are advised not to rely on any information contained in the broadcast in the process of making a full informed investment decision. This is Your Money, Your Wealth on Talk Radio 760 KFMB. Now, here's Joe Anderson and Big Al Clopine.
It's a little bit after the hour. Good morning, everyone. Show's called Your Money, Your Wealth. My name is Joe Anderson. I'm a certified financial planner. I'm with Alan Clopine. He is a CPA. Thanks for tuning in. Next couple of hours, talking about your retirement, financial planning, mortgages, taxes, the market, I guess. Larry Swedrow's coming on
Yeah,
today.
I can't wait for that. See what he has to say.
So a little hodgepodge, potpourri of some stuff.
Yeah.
So you know what that means? Al and I are not prepared for the show.
It's every show is a potpourri.
We got a couple of articles, right? So, you know, we got a crack research team at Pure Financial Advisors that prepare us for the show. Because Al and I, we work 9 to 5, or not 9 to 5. Alan works like 9 to 3. I work 9 to 9:30.
You do when you teach.
And so, and then Saturdays, we're here being the financial planners to you on the air. And so it's sometimes getting all of the information that we would like to discuss, so we have some people to help us.
So don't admit so early on the show that it's going to be terrible.
I'm honest. It's the new fiduciary rule that I'm living by. Honesty is the best policy in this.
I suppose.
But I guess here's the point. We saw a bunch of different articles, and we're like, let's dive in this. You know, this could be pretty good. And then as you dive into them, most of the advice out there is awful.
It's terrible. I got an article from Investment News, how to manage tax-efficient drawdowns in retirement. They had talked to 2 experts. The first one was right on. The second one, way off the mark. In fact, 2 out of his 3 suggestions were completely wrong.
So we'll dive into that. Then there's a couple of other things everyone needs a financial advisor, and how do you pick a right financial advisor? I've said this a million times. Everyone does not need a financial advisor. I think everyone needs a financial plan.
Agree.
Right? Everyone absolutely needs a strategy, a financial plan to make sure that they know what they need to be doing.
Right.
But can they do it themselves? Sure.
Yeah,
a lot of people can if they want to do it themselves.
Most, I would say, probably do it themselves.
Could an advisor add value? Well, I think it depends. I think it depends on what type of advisor that you're working with.
Right.
Right?
Yeah, good point.
What are they looking at? Are they selling you a product? Are they looking at your overall situation? Do they have any expertise? You know, because, and I didn't want to do this, but I'm going to do it anyway.
Really?
Right?
So early in the show?
So early in the show. Is that when it came to building Pure Financial Advisors, our firm now,
yes,
is that we looked at, all right, well, there's a lot of criticisms in the industry, and I'm one of the bigger criticisms, a critic of the industry that we work in. And Al, you were a CPA before you got more onto the advice side of things.
Correct.
And so you had your own preconceived notions of what financial advisors, quote unquote, actually do or do not do. Right? And I think some of the public has those same preconceived notions because most of the industry, or majority, they still just basically are salespeople selling products.
Right.
And which is fine. That's their function as long as the person across the desk or the table understands that what is their function. It's not they're giving comprehensive financial advice, looking at ways to reduce your fees and costs in the overall investments that you have, or figuring out a way to take the income from the overall portfolio, reduce your taxes, maximize your Social Security, pass the wealth to the next generation, looking at all sorts of different things in a coordinated way, taking a look at all the different disciplines. Because you have estate planning, you have taxes, you have investment management, you have cash flow planning, and everything in between. And so once you have all of those intertwined, I think that's when people are most successful financially. The problem with the industry is everything's segmented, right? You know, you have a broker that might be selling stocks, bonds, mutual funds, variable annuities, fixed annuities, whatever it is. And then you have the CPA that's doing their own thing. And then you have the estate planner, they're doing their own thing. And so what we've tried to do at Pure Financial Advisors is making sure that all of those different professionals communicate on behalf of the client in a true 100% fiduciary manner. Right, so we don't sell any products. There's no commissions generated to our firm. So we figured that was one of the largest criticisms. So we nixed that. Let's be fee only, fee for service. If you want some service, charge a fee, boom. So then credentialed professionals is another huge one. I think the last study I saw, 4% of all financial advisors are credentialed with a certified financial planner designation.
Right, that's what I saw too.
And what all that means is that they've really taken pride in their craft, is that they dive a little bit deeper in what they're trying to give to their clients. So they have a broad knowledge of all the different areas of financial planning in regards to how do you create income and cash flow, looking at taxes, investments, insurance, estate planning, and the like. And, it's a 2-day test. I think that's when I took it. It was a 10-hour exam. It took over 2 days. I think now they crammed it into one. But it's a challenging test. It's a 2-year program. You have to have a bachelor's degree now, and so there's a high level of education for someone that has that credential. And then we looked at taxes. I mean, to combine the interrelation between CPA and financial advisor and money manager and estate planning, that has to be combined, in my opinion, because everything that you do when it comes to your investments is going to affect your taxes. And everything you do with your taxes potentially could affect your investments. And if your investments aren't properly allocated, you're not going to get the income that you need, or you might be paying too much money in taxes. And then, guess what? At the end of life, it might go to the kids, and it might get blown up in taxes on that aspect, or it might get stuck in probate, or it might go to someone else that you didn't want it to go to. So all of this, right, you want to make sure that you check everything off. Instead of saying, well, here, I'm going to go to my CPA, and then I'll go to my advisor. No, you want everyone kind of sitting around the same table, taking a look at your overall situation for you in one swill, one clean...
One fell swoop.
One whatever movement that I'm trying to say here. Whatever.
Okay.
So...
Well, that was good. And I'll tell you, so I have been a CPA for, I don't know, I think I got my certificate in 1984, so that would mean 32 years being a CPA. And I had in my own practice for 17, 18 years, and so I did have a preconceived notion. And in fact, I ended up merging my practice in with another financial planning firm, and I thought I would merge in with a larger firm. I kind of wanted to get out of tax preparation and more into tax planning. And so I got in with this other financial planning. In fact, that's where you and I met. And I found out that most of the industry is just like you described it, which is people are trained how to sell products, and they do a good job at it. And what's confusing to people that are not in the industry, that are trying to get their services, is it seems like they'll go to somebody who's a salesman, but that salesman will say, I'm a financial planner. I do comprehensive planning. They really don't, but they say they do, and it's very difficult to discern.
Sure, because it's a buzzword.
Right.
But once you dive in and say, okay, well, what does that actually look like? What is the value that I'm getting from this financial plan that you're going to put together for me? Someone is just saying, hey, I think you need to save a couple of extra bucks, or here, maybe put more money into a 401k plan.
Right.
And here's your allocation.
Are you getting good advice? And also, you can ask them how they get paid. That's actually probably the single best question. And if they are fee only, they'll talk about, well, I don't get any commissions. I get paid only from you, from either fees for services or maybe a percentage of assets that I manage. That's fee only. A lot of the rest of them, most of the rest of them, it's commission. And then there's always this concern, am I getting the best product for me or not?
Right. And so now the DOL, Department of Labor, is really trying to hit this fiduciary rule across the industry. And we'll stay tuned because our firm thinks it's a phenomenal thing because we act as a fiduciary 100% of the time. So there's no changes with us. But if you take a look at some of these big brokerage firms, you look at some of these big insurance companies and everything else, they're like, oh my gosh, I don't know what we're going to do.
It's going to change everything.
It's going to change everything because now we can't sell these products, or we have to disclose the commissions, and we actually have to, have the client sign off and saying, hey, we are getting paid X for this, and it's like, well, we don't want to do that because for years we were able to, position. I heard this radio show just the other day. God, it drove me nuts. He's talking about a fixed index annuity, equity index annuity. It's one of the most highly commissionable products out there, but it's sold as like the holy grail of investing. It's like, oh, look at how bad the market is. Well, with my product, you can get stock market returns with no downside risk. I mean, if that was the case as a fiduciary, I would potentially put all of our clients in that thing, right? If that is truly the best investment. It's a bunch of BS because it's a fixed annuity. That's what it is. And you can get a higher rate of return than maybe the standard fixed rate, but you have to understand the inner workings of that particular product. No one is that nice. These insurance companies are not saying, you know what, yes, we will give you stock market returns, but we'll take on all the risk for you. Why would anyone do that? It's not logical. Well, then you don't understand the mechanics and how it's constructed. Of course I do. It's a zero coupon bond. They're buying call options on the overall S&P. But you got to take a look at how much money's invested in whatever. And then the guy goes, well, let's talk about commissions. He's like, well, no, yeah, that's a great question. Thanks, Steve. He goes, yeah, zero commissions. Yeah, you don't pay me a dime. If you put $100,000 in this product, you don't pay a single commission. The insurance company pays me. It's like, well, the client pays the commission. It's just embedded in the overall product. And yeah, all right, so if I invest $100,000, sure, I'm going to see $100,000 on my statement. But let's say tomorrow I need that money because, my spouse got in a car accident and I need some cash, to fix the car. Well, then you're going to, lose whatever. It's just all smoke and mirrors. It drives me nuts. Anyway, I went on a tyrant. I'm sorry. I apologize. If you want more information on our firm, you can always look us up at Pure Financial Advisors. Pure. That's the name of the firm. The reason for the name is that we want to just give pure advice. PureFinancial.com. All right, we're just getting started. Got a lot to go. I want to get into some tax planning. I want to reiterate some of the things in the bill, the budget that President Obama is really fighting for this year because, of course, it's his last term. So there's some things that you want to be aware of and some strategies to make sure that you can take advantage of everything in the law today. Al's going to get into some of the political rhetoric when it comes to taxes, and we can see what's good and bad there because everything sounds pretty rosy. Oh, hey, flat tax, that sounds good. Do you think that's actually going to happen? So we got a lot to go. So don't go anywhere. Show's called Your Money, Your Wealth.
This is Your Money, Your Wealth on Talk Radio 760 KFMB.
Welcome back to the program. The show's called Your Money, Your Wealth. My name's Joe Anderson. I'm a certified financial planner with Big Al Clopine. He's a CPA. Thanks for tuning in today. Appreciate your listenership. Al and I have been on the air now just about 10 years, talking finances, taxes, investments, retirement planning, and so on and so forth. So thanks so much. We also have a television program. It's called Your Money, Your Wealth. It's airing on CBS tomorrow morning at 6:30 if you're in San Diego. CBS 8. Is that right?
That's correct.
Okay.
Yeah, and if you're in Orange County, we're on cable. I think it's cable channel 31 at 10 o'clock, actually right now, right as we speak.
And then Los Angeles, just go to our website, purefinancial.com, or go to yourmoneyyourwealth.com. Yourmoneyyourwealth.com is another place to, if you want to get some glimpse of our television program. Because here's what we've tried to do over the years, is really inform and educate you on things that you should be doing with your money in regards to strategy. It's like, all right, well, how do you save money in taxes? How do you create the income and so on? But then I think on the flip side there too, we want to protect you against unscrupulous sales practices and things like that because we know the industry, we're in the business, and we see good, bad, ugly all day, every day. And so for the average consumer or client is that, all right, well, they might hear bits and pieces when it comes to maybe a radio program, or if they go to a workshop, or maybe what their neighbors are doing and things like that, and they might not be experts in the field of finance and how all of this stuff works. So at times we might go on a rant and talk about certain things that sound pretty good on the surface, but in reality may not be the best route for you. So just do your due diligence. You want to do some background work with any advisor that you do work with. You can go to brokercheck.com. That's on the FINRA website to see if, the advisor that you're working with is, been filed bankruptcy, or, they can't take care of their own financial house. You might not necessarily want them taking care of your financial house, or if they've been sued before. So we have a SAFE survey on our website at purefinancial.com, and there's just a list of questions that you probably want to make sure that you do some due diligence, I guess, beforehand. So this budget bill, Alan.
Right. Yeah, this is Obama's budget bill. It's his last one, his last term, his last year. And he's trying to put through a lot of things to sort of, I guess, go back to his 8 years ago, kind of some of his campaign promises. And in the tax realm, there's a lot of strategies that he's trying to get rid of. There's the NUA, which we can get into. We can backdoor Roth. We can get Stretch IRA. That could be on the chopping blocks. So right now, I think it's important, Joe, to realize what some of those strategies are. So if they do apply to you, that you make sure you take advantage of them while they're still here.
Right. I mean, we're almost March, right? March 1st is what, on Tuesday?
It's on Tuesday, yeah.
Right. Okay. So we got about a month and a half until the tax filing deadline,
right?
Which is April 15th. So a couple of things to consider here is that you can still do Roth IRA contributions for 2015 all the way up until April 15th of this year. All right. So most of you might be saying, you know what, Joe? Yeah, I would really like to put money into a Roth IRA, but I make too much money. Okay. So you have to take a look at the AGI limitations, because I teach a retirement planning course all over Southern California, and that's still one of the biggest things when I talk about Roth IRA, Roth planning, is that still most people think they don't qualify to do it because of their income. Well, here's the income limitations. First of all, you have to make, a pretty good, handsome living for you not to qualify. And I know there's a lot of you out there that make a couple $100,000 a year, but still, I think sometimes people think, well, hey, I make $100,000, I don't qualify. No, here's the limits when it comes to AGI. So that's adjusted gross income. It's the bottom page of your 1040. Take a look at that. All right. So if you're married, below $193,000. So the phase out's $183 to $193. So if you make less than $183,000 of adjusted gross income, bottom page of your 1040, tax form 1040, that you qualify for a Roth IRA contribution. I would highly encourage you, if you do have $5,500 or $6,500 if you're over 50, to make sure that you contribute into the Roth IRA before April 15th for a 2015 contribution. The reason why you would want to do that is now that $5,500 or $6,500 will forever grow tax-free. So if you have money in a brokerage account, wouldn't you rather, where those assets are going to be taxed at a capital gains rate, rather put it into a Roth IRA where then all of those dollars grow 100% tax-free, right? So it's just looking at where you're positioning your assets. Sometimes you might have to take a couple of extra steps here. Instead of saying, yeah, I got money in my 401k and I'm good, or hey, I'm contributing to my 401k, Alan, I can't contribute to an IRA. How many times have you heard that?
Yeah, we hear that all the time, and those are not related. The truth is you can contribute to a Roth IRA or even regular IRA. There's rules on when you can and can't do it. Joe, I wanted to just illustrate an example of a couple that I saw earlier this week, and they didn't really know much about Roth IRAs. They had a bunch of money in 401ks and so forth, and their income was below those limits. Let's just say their income was around $125,000. Adjusted gross income. So clearly they're below $193,000, actually $183,000 is where the phase out starts. So they can do full Roth IRA contributions. They were both over 50. The wife was working, the husband was retired. Okay, so all right, so the wife, so she could do a $6,500 Roth IRA contribution for 2015. And guess what? The non-working spouse, the husband who is retired, he can also use the wife's income. It's called a spousal contribution. So the spouse, the husband, couldn't put in $6,500. That's $13,000 for 2015. Now we're in 2016. Same day, they can put another $6,500 in for 2016, each of them. So just like that, they can end up with $26,000 between the two of them in Roth IRAs, which is money that'll be forever growing tax-free. Now, of course, you have to have the money to do it, and they did. They didn't know that this was available to them.
Right. So then piggybacking off that, let's say if you make more than the $193,000. What is available now is called the backdoor Roth contribution. So you make more than $193,000, you put those same limits that Al just talked about, $5,500 or $6,500, into a standard IRA. Right? So you need earned income, though. So this doesn't apply for those of you that are retired or do not have earned income. Earned income is wages or self-employment, Schedule C income. If you have income that's over the 193, boom, okay, right? So you can put in the IRA contribution. Then, because you make more than the 193, you can't take a deduction here. So what you have now is an after-tax contribution in that IRA plan. Then you can convert that into a Roth. Because you didn't get the deduction going into the IRA, there's not going to be any tax when you convert it. So it's an after-tax contribution to an IRA. You take that IRA and you convert that directly to a Roth IRA. You could do that for 2015 and 2016. So that same $26,000, if you're married, put those into IRAs and then automatically convert them. It's another way to get money into a Roth IRA as a direct contribution, but it's just a backdoor contribution to basically, get you to where you need to be from a tax perspective.
Yeah, and just a couple caveats.
And we can get into that after the break, too.
I was just going to say, if you have other IRAs, this may not work, and you can't be over 70 and a half, but otherwise this works great.
All right, we got to take a break. Show's called Your Money, Your Wealth. We'll be back in just a second.
Now back to Your Money, Your Wealth on Talk Radio 760 KFMB.
Hey, welcome back to the program. Show's called Your Money, Your Wealth. My name's Joe Anderson. I'm a certified financial planner. I'm with Big Al Clopine. He's a CPA. Thanks for tuning in today. What I want to get into, Al, is that did you watch the debate Thursday?
No, I saw some of the highlights though. I saw. I think the next morning I saw. I guess the top one-liners by Trump. So that's all I saw.
That's interesting.
It was a circus.
One of the things, when we get is that these candidates have a tax plan.
They
do. We can start with the GOP because their tax plan always sounds a little bit better than the Democrat tax plan.
Yeah, especially if you're in higher tax brackets.
Yeah, right. And so... And most of our listeners, I would say, are probably in higher tax brackets than lower tax brackets. But
Sure.
I'm not classifying them as Democrat or Republican.
Sure, right.
I'm just saying the amount of money that they pay in tax might be a little bit higher if they're listening to a financial planning show.
Yeah, and Joe, it's interesting. Donald Trump, for example, he would like to change our tax system with 4 different brackets, starting at 0 and going up to 25%. Right now, we start at 10% and we go to 39.6. So in other words, tax rates are lower. And then capital gains, it's like, well, what he wants to do with capital gains is pretty much keep them the same. And as far as itemized deductions, so how do you pay for some of this? Less itemized deductions. He still wants us to have our mortgage deduction and our charity, but that's it.
So we, like here in California, we wouldn't be able to write off our state tax.
Correct. We have high state taxes. We have high property taxes.
So what would that add to the bottom line from a tax perspective to us? Like a percentage, so let's say the highest rate would be 25%, but if I can't deduct my state tax, which is 10% in California for most.
Yeah, so you're still going to end up in a lot better situation if you're wealthy or you're reasonably wealthy. You'll end up just paying lower taxes. The problem with that, of course, I don't have to tell you guys, is we're not actually currently balancing our budget. In fact, every single year we're spending more than we're bringing in from tax dollars, and so our long-term deficit, it just keeps getting worse and worse and worse. And so now you can argue supply side economics, and I'm not going to get into all that right now. I'm just talking dollars and cents at the moment. Now, it is kind of interesting when you get into Ted Cruz's plan. He wants to do a flat tax. That's completely different. He wants to do a 10% flat tax across the board. Married couple gets a $20,000 exemption. Single person gets a $10,000 exemption. I should say standard deduction. And then $4,000 exemption per person. So a family of 4 wouldn't pay a dime of tax until they hit $36,000. So the first $36,000 would be tax-free. Everything above that would be taxed at 10%. So it sounds like a pretty good plan. But I ran some numbers, Joe, and a family of 4 making $100,000, their taxes would be roughly the same. However, a family of 4 that makes $1 million, their taxes would go roughly from $300,000 to $100,000 in rough numbers. They'd save a couple $100,000, which again sounds great. Are we in surplus situations in the government? No. So how is this going to work? Well, his proposal is to do a value-added tax on corporations of 18%. So in other words, corporations would take their gross income and they get to deduct a few production costs if they're a manufacturer, and they get this net number, which is not their profits. It's a much higher figure than profits, and then they got to pay 18% of that to the government. And so if you just think about this logically, what does that mean? That means corporate taxes will be much higher, and that will be passed on to you and me and all of our listeners in terms of goods and services. And who is that going to impact? It's going to impact the lower class and the middle class, and the wealthy will end up with a lot more money in their pocket. And it's to me, and I'm not going to say I'm Republican or Democrat. If you listen to the show a while, you can probably figure it out. But to me, it's not necessarily a very fair system, and it's why it seems to me every single presidential election it comes up, and it never seems to go anywhere, because to me it's a bit of a flawed system.
Doesn't he understand arithmetic?
They're trying to get elected, right? They're trying to get elected. That's the problem. And so they have all kinds of wild things. Now, on the other side, quickly, Hillary wants to raise our highest bracket from 39.6 to 43.6, and Bernie Sanders would like our highest rate to be 52%. So now we're going the other extreme. So stay tuned. We'll see.
Well, right now the highest rate still is with 39.6, but then you had here, state of California, what Phil Mickelson wanted to leave because he was paying, 53%?
Yeah, Phil
55.
Phil Mickelson was saying a 60% tax, which if you're counting your maximum federal, let's call it 40%, and maximum state, that's 13%, so now you're at 53. And if it's self-employment earnings, could be another 15%, although he would blow past the limit for pretty quickly.
Right.
So it would basically add another 3%, and then another, call it 4% for the Medicare surtax. And then when you make more income, you're phased out on itemized deductions, so it could approach 60%.
So let me ask you a question. So let's say I'm self-employed.
Yeah.
So when self-employed individuals, they have to pay both sides of the FICA tax.
Correct.
So they have to pay the employee and the employer side. So Social Security, just round it, call it 7%.
Okay.
And then so 7% for the employee, 7% for the employer.
Right.
And then that for the employee goes up to about $120,000.
Correct.
All right. So if I'm self-employed and the business brings in 100, or let's say $1 million, so I pay for the employee up to that 120,000. Do I have to continue to pay that employer side, or only to the 120 on both sides?
No, just to the 120. But the employer has to continue to pay the Medicare side, right? The Medicare side it's call it 3% for both.
Both.
So it's 1.5%. I mean, we're rounding, but that's roughly the numbers. But I want to tell you something, Joe, and I think a lot of people don't realize this. If you are married to somebody who's making a lot of money, well, good for you. But if you
I need to find that.
Yeah, you do need to work on that. But if you then turn around, so maybe your husband or your wife, it doesn't matter who, has a professional job making a bunch of money, and you're trying to figure out what to do, and you decide, I'm going to start a self-employment business because I want to make some money, I want to have some of my own spending money, I want to do this and that. Let me tell you the taxes that you'll pay if you're already in the highest bracket because of your spouse. So if you make, let's call it $20,000, for example, profits from your business. Well, between federal and state, you're already at 50% tax. Okay, so you lost $10,000 of what you made. Okay, now self-employment tax is another 15%, right? So you've already lost another $3,000. So now, before other phase-outs and things like that, you've only net $7,000 from your $20,000 of profit. And I guess what I'm saying is when you are married to a spouse that's making a lot of income, your self-employment income is pretty highly taxed because you're already in the highest bracket and you got self-employment tax to boot.
So unless they're not very good at their small business, Al.
Yeah, and then they
then if
lose
you create
money.
losses.
Yes. Whether it's real or fictitious, now you can save taxes, right? So
yeah, my spouse is not very good at the business.
Somehow,
that's why we have all these huge losses.
Yeah, that's right. And that people don't realize that either, which and that's actually pretty common in the first year or two of a business.
All right, we got to take a break. Don't go anywhere. The show's called Your Money or Wealth.
This is Your Money, Your Wealth on Talk Radio 760 KFMB.
Hey, welcome back to the program. Show's called Your Money or Wealth. My name's Joe Anderson. I'm a certified financial planner. I'm with Big Al Clopine. He's a CPA. Go to our website, purefinancial.com. Go to the Learning Center. We got hundreds of videos on that Learning Center. We keep adding more. So if you have a question, do so at the Learning Center. I also did a webinar on Social Security strategies.
Yes, you did.
That was last week. I believe it was Tuesday. 400 people, I believe, attended the webinar. It was mostly for our clients. I think we talked about it maybe for a couple of seconds here.
Sure,
but that's also, if you wanted, it's an hour long, so if you want, because there's claiming strategies that you want, or there's definitely changes in the law that will come into effect here. April 28th is actually the true date. April 28th. It was the 30th, but I think the IRS just came out, or Social Security Administration came out with a letter saying it will be the 28th versus the 30th.
It's actually the 29th.
Oh, is it the 29th?
It was the 30th, and now it's the 29th. Yeah, and so if you haven't paid attention, what was it, October, maybe, November? The budget was passed by House and Senate and President, and they kind of snuck one in on us, which is some changes on the new file and suspend guidelines. And so what they said is if you're already doing it, no problem. And then they gave certain age limitations where you could continue to do the strategies, but if you're younger than that, you can't do this anymore. And I guess in a nutshell, the strategy was this. The one spouse that got to full retirement age, which right now is age 66, could file for benefits and suspend, means that they don't actually receive their benefits. And they wait, then you go, well, why would you do that? Well, this is why, because then your spouse can file, I think you call it a restrictive application. Is
Yes,
that
sir.
accurate, Joe?
Yeah.
And then
Or it allows minor children to claim benefits and things like that.
The point is, though, that the other spouse can claim benefits for half of, in other words, can start receiving income for half of your benefits once they get to full retirement age, and they can actually receive it earlier. And it gets so complicated, I won't even worry about it right now. But anyway, they could receive half of your benefits starting at age 66, and their benefits would continue to grow till age 70. So it's kind of like you get this free money from age 66 to 70. You could still both, husband and wife, let your benefits grow until age 70, and then you can receive those full benefits. And what they said was that, all right, so you have until now, April 29th, the older the spouses, if they want to do this strategy, has to file and suspend.
Yeah, you got to be full retirement age before April 29th and do the file and suspend strategy before that date. So
That's
if
right.
you are full retirement age and have not filed for your benefit, I would highly encourage you to talk to the Social Security Administration.
Yes, absolutely. And then the younger spouse has to be
62.
At age 62 by December 31st of 2015.
So we break all this down in an hour-long webinar that is now that you can get on demand. So go to purefinancial.com, go to the Learning Center, and you can find it there, purefinancial.com. Alan, who do you think are better savers, women or men?
Women, I would say.
Turns out that women rule the roost when it comes to saving for retirement. So Vanguard. So they show that women are the ones signing up for 401k plans and saving a larger piece of their salaries compared with their male counterparts.
Yes, I do know the opposite, though, is true. When they get to retirement, men have more money than women. And there's a couple reasons for that.
Wow. Well, I think that trend will be changing. I think that is today. I would say in 20 years, that's going to probably be the opposite.
Well, let me tell you what's going on today. So the two reasons why that's
because
true.
You have to go back 20 years, and probably women didn't have nearly as high as income as men.
Well,
women didn't work, and
actually,
then men did all the savings.
That's actually one of the reasons. And still today, women make around, I think I just looked at this, around 79% of what men make. So men might be saving a lesser percentage, but it turns out to be a higher dollar amount. But the other thing, Joe, is this. Women tend to be more conservative.
They're better investors.
In their investing, and men tend to be more aggressive. And if a male can be more aggressive and let it run, they do better than a super conservative investment. The problem with men is they get in and out of the market.
Yeah, but women rates of return are better than men's.
I don't think so. At least in an article that I read.
Well, that article was BS.
What the article said was that men are more willing to take risks.
Yes, but then they get in and out, in and out, in and out. Oh, that sucked. Let's buy another one. Let's get another one. Let's double down on this. Right? It's the tortoise and the hare.
Yes.
Let me go back to a little nursery rhyme for you.
I'm still thinking about the men getting in and out, in and out.
Oh, wow, Clopine.
Well, you said it.
The stock market.
Oh.
And they're aggressive when it... Oh, my. So Vanguard looked at 720,000 workers who were eligible to sign up for their employer 401k plan. The study found out that women are 14% more likely to voluntarily take advantage of the pre-tax retirement savings accounts. Women also are saving anywhere from 7% to 16% more than men, depending on income level. So you got to read the right articles. The average account balance across all income levels for women was $80,000 versus $123,000 for men. That imbalance is somewhat skewed, however, by large differences of the higher income range.
Yes.
So that kind of piggies back on what you said.
So you're agreeing with the first comment, not the second one.
Yes. However, men in the study earn more. For instance, 45% of the women had an annual salary less than $50,000 compared to 28% of the men. Additionally, although women generally get a bad rap for being more risk-adverse than men, the study shows that both genders allocate a similar amount of their retirement money to stocks, men 74%, women 73%.
Really? No, that is different than what I read. Okay.
Men and women are investing more similar than differently, said Young from Vanguard, who pointed out that both also have similar portfolio assets in index funds, men 64, women 62.
Okay.
So
Like it. All
in
right.
looking at annualized 5-year investment return, the study found that men edged out women 10.1% to 9.7%, respectively. The study points out, however, that at the high end of the risk exposure, men in the study were more likely to have a greater stock exposure.
Sure.
But that's 5 years, Al.
Yes.
I want to go out the next 20 years.
Right.
Okay?
You think it's going to flip?
I think so.
Okay. All right. I got you down for that.
Right?
Yeah.
All right. So people in their 40s, they will be in their 60s in 20 years.
Yes.
And so people in their 40s now are, if they're married, I would say both spouses are working.
Yes.
And
very
I would say
common.
the income of those spouses is not hugely different,
Yeah, in many cases.
is what I see from my practice, and I'm in my 40s.
Right. Right.
And my friends and my, colleagues and everything else.
Yes. Okay. I'll buy that.
Yeah.
Okay.
It's Women's Entrepreneurial Day, November 24th, by the way.
Is it this year or is that an old article?
Just in case you wanted to know that
Probably
one.
2012.
No, this article was written by Sarah O'Brien.
When?
Thursday, the 25th of February, 2016.
Oh, so you're right up to date.
What's the date today?
It's the 27th.
Right. See, I'm hot off the presses, Al. People, they
Got it.
send me hot articles. Your article was back in the 60s.
Yeah, well, that's what I understand.
All right. Well, if you're male, female, tall or short, skinny or fat, doesn't matter. You need to save some money. You know what I mean?
Really? You call out the fat people?
Well, under tall. Under tall.
Under tall? Okay.
Yes. Got to take another break. Show's called Your Money or Wealth. We'll be back in just a second.